Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, trying to get ready for the week ahead. Good evening, Rob. How's everything?
Oh, great. Yeah, it's going to be a very exciting week. We got lots of stuff packed in. I think a very concerning week for many too, and really hard to plan, properly, including looking at our data and in a sense of what's like. We go day by day, so I mean as the week plays out, we'll be able to adjust a little bit. But when you got so many earnings packed into this week, you've got the Fed, you've got seasonality. We're on the back of a rally that kind of stalled on Friday with snap earnings, and yeah, I mean it's kind of a critical week for the bulls too to latch on to building off this rally. So I think all things considered, one of the more challenging weeks we've had in this last couple of months here. So
yeah.
Well, let me rattle off what the futures are doing right now. So as they open at 6 o'clock Eastern time. We've had some time for them to, either build or fail. But the Dow Jones futures are down 49 points, so not too much, only 0.15%. S&P is down 6.5 points, or 0.16%. NASDAQ 100, where we were showing some interest in tech stocks last week for sure. That's down slightly now at 12 points, 12 and a quarter, and 0.10%. And Russell also had, until Friday, had some really good run on the small caps. And then Friday they got everything that was up got pounded pretty good. Minus 1.9 points, 0.11%. Nikkei up slightly right now. Euro also rolled over a little bit, down 30 points, or 0.83, and the DAX 117 points off, 0.88%. And the VIX futures up slightly, 0.29%, or 0.29 points, which is 1.16%. I want to bring people's attention to what I would think would be the lost art of vertical bar analysis. I don't use charts for trying to predict the future. I use them for if-then statements, to look for gaps and potential gap fills, to look for matching highs, matching lows, any sequential closes where you have numbers that become really important. So let's just look at the Dow Jones futures for a moment. And again, if you go to the ETF DIA, it's going to be slightly different, but very similar. You just don't have the overnight context on those. So, but let's look at something here for a minute. We had a low set in June of 2021, and that came into play again January 24th of 2022. And when you bounced up from those, you went back to, say, June of 2021, you went up to August of 2021. And then when we bounce back, you see some of those numbers come in this year again. When we dropped in February 24th, incidentally, the number that we just rallied back to on Friday, where the futures actually were, overnight futures were up. So that number was almost bang on with the February 24th low. The rally that we had from May built for like a week and a half there, a really good rally in May. And that came right up to matching many of the lows that we had at the beginning of the year and also in September and October. So, you know, really important to kind of write down your numbers and think about where we're likely to move to if we, you know, go in a particular direction. So now if we're going to roll back, there's a key number, which is the May 12th low. That would be kind of the first place a multi-day down session would take us, I would think. And if that doesn't hold, then you have the low again from May 23rd, or sorry, May 20th, the May 20th low. And that would be the next one down. And then obviously heading back down to where we just came from, which would be the July 14th low. So you've got quite a few numbers in there. And so all you do is look at your extreme lows, highs, especially if you get reversals like what we had with May 20th. May 20th was a price discovery, which broke below the low of the previous day. And then it rejected that and closed pretty much on par with the previous day's close. And then we rallied from that. So that number, that May 20th low, I'll give it to you on the Dow Jones futures, is 30,585. To give it to you in the with the diamonds, back to May 20th. May 20th low on the diamonds is 306.28. So just like the February 24th low was 322.69, on the diamonds on Friday, the high was 322.20. See how close that was, Dave?
Yeah.
I mean, you know, these things track right back to these key numbers. So again, you're looking for daily bars. You would look for the low of a daily bar when you had a major reversal, any type of price rejection where you had new price discovery, but then it rejected it and closed higher. Those reversal bars are incredible numbers to jot down. Okay. Then anytime you get consolidation where it spends, you know, a lot of time in one area, like we had from May 27th until June the 7th or so, we spent a bunch of days consolidating. That's around the middle point is around 330 on the diamonds. So if we moved higher, that would be a natural progression, is to fill any gaps and then move up to that consolidation level. Okay, so think about consolidation and then trend break, reversals, and matching highs, matching lows. And that can help frame things for you guys. Okay, so you can do that exercise on this, you know, the S&P futures, the SPYs, the NASDAQ futures, the Qs, the Russell futures, and the Russell IWM. Okay, but just jot them down, and so that you remember to, you know, think about how to get the most bang for your buck. Like if you're short and you want to, you know, maximize the trade, it's good to know where it's likely on a probability basis to move towards. And there's a, you know, it's also good to flip to the weekly and to the monthly and look at it, and you'd be surprised at how things play out even over the course of a month or two. And it's like that sentiment, you know, you pick up on where the most buyers are or the most sellers. And so This is a critical week, and we're just on the back of, we had a rally, kind of paused on Friday with, like I mentioned, the snap earnings kind of affected the sentiment. And now we're coming into a week where we have a lot of earnings, and we have a Fed announcement, we have seasonality and things like that. So let me roll over to Dave. What are some of the seasonality implications first here?
Yeah, so looking at the almanac, again, for the month, the SPDR is expected to do plus 2.7%. And the past week alone, we almost did the entire amount of that. Even though with Friday's pullback, the SPDR did 2.59% for the week. So we're coming in with this big rally, kind of a lot of strength on the front end, and the last week is a little bit soft. So the last 5 days, we're expected to do minus 0.15% for the final 5 days, which is this Monday through Friday. And I looked at some of the sector ETFs within that to see which would be stronger or weaker than the SPDR. And it looks like being longer, some more defensive things, and shorter, some of the more risk on. So longer things like real estate, silver, gold, utilities, healthcare, and staples relative to the SPDR, and to be shorter things like financials, energy, XOP, basic materials, and discretionary. So they all kind of line up that it's a softer week in general, according to the almanac. Be longer, a little defensive sectors, be shorter, some of the more risk-on ones. And the fact we've come into this week from kind of a period of a premium, right? We've had a big, strong rally in the month and the past week, so we could get even softer performance than the almanac expects.
Yeah, it's amazing that, you had sentiment got so bad there, and, and everybody, they forget about this seasonality aspect, where it doesn't look like the month could perform, and sure enough, it goes and it performs on par with, so far with what's expected for July. So it always amazes me how seasonality holds up. Last year, actually, we were a bit ahead. We got over 3% briefly, and it was expected to be 2.7% for the SPY. But we got a bit ahead of that, and then we pulled back to close, I think, at like 2.6 or something. So it kind of mean reverted right at the end of the month, and so we can see possibly the same thing here, pulling back again. We've got this recession implication again too. So that this is a theme that's been building over the weekend, and we're kind of concerned, I guess, for what the Fed ultimately will do. Well, they've indicated before 3/4, but would they do a full point? The pressure is building on them to reel in inflation, and I do see some signs of inflation abating in some areas. You can see that because the US dollar pulled back a bit and caused a few of the commodities to, pop a little bit, but the trend has been, down for some of these commodities already. So maybe a short-term little pop for them, but some of that pressure, like we talked about, like sugar and lumber, and there's a number of commodities that they're well over their peak. So the thing with oil is, oil can respond to the interest rate hike. Oil can also respond to peak oil sentiment that's been going on with the Saudi limitations on production. Oil can be impacted by the recession, so it's really a battleground here, and it can be a little bit more of a dangerous area to play in still. Do you, Dave, do you like taking any oil stocks in your baskets at all, or no?
Well, right now, I think this is tied to more of the recession risk. I mean, like even tonight, it's down a little bit, but based on what the talk of recession and demand destruction. I mean, as part of the Dow Jones, I trade like Chevron, but not as much as it's too risky, right? There's other things to play.
Well, I mean, it's a little different with like natural gas has been rallying recently, where oil's been pulling back. So it's, oil cost per barrel and also, refined gasoline. That's been pulling back. You've seen some break at the pump down in California, haven't you?
Yeah, we were up to $7 a gallon. Now we're down to like below 6. So
yeah, so it's pulled back a bit, right? And again, that plays into part of it, part of it may be the strategic oil fund that has been utilized to provide some barrels. Apparently, the type of oil that's in the strategic fund is similar to the Saudi quality or Russia, even Russia quality. And so it's like we've been selling our best or pulling out of the strategic oil reserve the best. And there's a lot that's been used. So I would hate for there to be a real need for the strategic oil fund in the future when there isn't any left or any of the good stuff left in it. So you kind of I don't know if you want to play that game of alleviating the pressure at the pump by utilizing a strategic reserve. I don't know if that's the solution, but anyway, it's going to be interesting. So have we seen any increase in the probability of the 1% hike versus the 3/4? Have you seen any recent adjustments on that?
Like Fed speak. I haven't heard Fed speak that's changed, but I mean, didn't Canada go with 1%? I mean, some other central banks are being more aggressive than us.
Yeah, I mean, Europe's moving the needle to get above zero. They're on that path. Canada did a shocker of 1%. I mean, there's a lot of pressure globally to not only to compete too, right? Because the stronger your currency can get, attract some investment and things like that, and your purchasing power for buying from outside of your country increases. So there's the competitive aspect, there's the inflation aspect, but I really think that this we're going to be experiencing what they call the bullwhip. Have you heard that term before?
Not that one.
Okay, it's kind of like where you go from one extreme or pendulum extreme to another. So, for example, if widgets were in demand, companies would ramp up to produce widgets, right? But then if you have a recession and nobody's buying widgets, then you have excess inventory. Then you got problems with inventory turnover, like we've seen. Remember, many of the retail stores back in the last recession, they had inventory turnover problems and blah blah blah, right? And it really impacted them greatly. And so then you kind of go through this cycle where too much inventory, and then they have to lower prices, so you have inflation moving to deflation, and then the process starts all over again. And if the Fed has to, lower rates again and stimulate the economy. So we're caught in this. Years ago we used to talk about it. We had entered the infinite age of moral hazard, and that was when all this QE first started, right back in 2009. Well, actually even before that, really in after 2000, 2001. So we've had this constant kind of playbook of messing with money flow, interest rates, all these things in an effort to keep something like a 2% target inflation going, or a certain amount of employment, or bailouts and things, and we're just caught in this cycle, this loop all the time. So we're going to swing from inflation, and we could swing from inflation, very aggressive inflation, which may be still a long runway on that yet, but we could swing from that to deflation very, very rapidly.
Yeah.
make you just stunned at all of a sudden the prices are just, do you remember, like, in fact, pull up a chart right now, Dave. Pull up a chart of XLE. Okay.
Yeah.
And go back on the monthly, okay, to 2008.
Mm-hmm.
Okay. So this was where we were going to, the talk was, 150 a barrel. Some people even had $200 a barrel for oil. That was on a target price, literally. And, everybody was going to move out of the country and into the cities and blah, blah, all that, right?
Yeah.
And then look at how we fell from pretty much almost 150 a barrel down to like 38 or something, right?
Yeah.
So the XLE doesn't show the price per barrel; it's just the energy ETF. But the point is that was such a rapid move in 6 months, like shocking, stunner. So what if you had factored in everything according to that expectation that oil was going to remain high and we were going to even go higher, and then you're suddenly caught. Like, think about people that hedged, even it could have affected airlines. All kinds of things can be affected. And then we just plunged down into the lows of 2009. And it took all the way to 2014 to rebuild out of that. So, are we going to see some of the same things happen? Like, if I look at the Bollinger Band spread right now between where we are at the top Bollinger Band and the lower Bollinger Band, it almost looks like a repeat of that could happen again, where we plunge down into the 30s.
Yeah.
So
or in 2020, remember we went negative on the price of oil. So
yeah, exactly. So that's sort of the bullwhip effect is that it's like a pendulum swing. We go from one extreme to another extreme. But the point being that we're caught in this cycle, recycle kind of thing. And it's going to be messy for many years to come. So that's good news, right? For trading, we want volatility, we want changes, but we have to be mindful of what is the regime change, right? What is happening? What is likely to happen? What is the markets factoring in? So the markets have already been factoring in, peak inflation. Now we may not be at the top, but you can see that's kind of what we had in this last rally. It's like, the sentiment's improving a little bit. We came off of 50 consumer sentiment. We went to 51.7. So it's an uptick, right? And then we rallied, right? And so the market starts factoring in these things. And I think it's important to be mindful of that and to plan our best. So I would say for this week, I think July seasonality has already shown itself to be quite reliable. So some of the ETFs that you mentioned and whether they're bullish or bearish for this week, I would definitely lean on that a little bit more. And then what are some of the large market caps that have earnings that could affect things?
I think 162 of the S&P 500 stocks have earnings this week, so it's a huge week for earnings. And the big players are Microsoft, Google, Visa, Coca-Cola, McDonald's, UPS, Apple, Amazon, Facebook. So it's like you name it. The biggest mega cap stocks all seem to be on the 26th, right? So not so much tomorrow, but Tuesday, Wednesday, and Thursday you can expect some of the big earnings, and that could really push the market one way or the other. It could really embolden the bulls or change the strength we've seen recently.
So on the multinational side, you could see impairment charges from FX just because the U.S. dollar has been so strong that if you're bringing in money from other countries, you have an impairment charge. So So to think about those versus really the more secure domestic stuff that is, but I mean, again, some of that could have been affected if they are exporters. The dollar's been strong, which makes purchases from other countries more difficult, and the demand could have fallen off. So I don't know if I would expect this earnings season to be that great, but earnings are still a bit of a guesswork, right? There are people that subscribe to like whisper numbers and kind of that, but I mean there still can be shockers. It was interesting to see Meta fall back down into this, because the earnings season before that, remember, it popped up. So it had a bit of a surprise and it popped up, and then now it's headed back down here. So yeah, this is the busiest earnings week. Every quarter we have one week that majority of the S&P 500 report. So be on top of your game, and sometimes you can have a gap down on, like if the report's in the morning, you can have a gap down at the open and then actually improve from that point. You can also have it gap up and then give it all back. So it kind of depends on not just the headline, but year over year earnings and revenue, quarter over quarter earnings and revenue. You got to look at the whole picture, and you also have to kind of know what was expected, what's really a surprise. And it takes a little bit to know if you should participate, right? Sometimes the best thing is just stay away and not trade something that has earnings, and that obviously gets difficult on a week like this. And that's why we're saying this is one of the more challenging weeks because of the rally we had and the snap earnings on Friday, which caused that reversal. And then we have the Fed and all that. So if you take it cautiously, we certainly don't blame you, right? Okay. All right. Anything else?
Well, good luck. Have a good week.
All right. Thanks, Dave.
Thanks.
Take
Bye-bye.
care.